The average middle-class family thinks their credit card is a backup plan, an emergency tool, a convenience, a little plastic cushion between them and disaster. But somewhere over the last 20 years, something strange happened. Banks stopped acting like banks, and families quietly took their place. Not officially. No contracts, no uniforms, no marble buildings with giant columns outside. But functionally, millions of ordinary people now do one of the most important jobs in modern finance. They create profits out of debt. And the weirdest part is, most of them don't even realize they're working. Picture this. It's 2003. A family buys groceries with cash, pays bills with checks, maybe uses a debit card sometimes. Debt exists, sure, but it feels heavy, visible, embarrassing even. Now cut to today. Coffee, tap. Shoes, tap. Medical bill, tap. Vacation, tap. Uber Eats at 1:12 a.m. because nobody wants to cook after work, tap. Debt no longer feels like debt. It feels like lifestyle. And that tiny psychological shift changed the entire economy. Because credit cards were never really designed to help people spend. They were designed to keep money moving, constantly, relentlessly, like blood through an artificial financial heart. Here's the uncomfortable part. When you swipe a credit card, the bank is not actually losing money. If you borrow $2,000 and pay it back slowly with interest, the bank makes money. A lot of money. But where does that money actually come from? It comes from your future labor, future hours of your life, future stress, future versions of you who haven't even gone to work yet. The bank essentially monetizes your future before you live it. Middle-class families became the perfect machine for this system. Not rich enough to pay cash for everything. Not poor enough to be denied credit. Just stable enough to keep the engine running. That's the sweet spot. A household with steady income, rising expenses, and permanent low-grade anxiety. In finance, that customer is gold. Because the modern credit card business isn't built around people who default instantly. It's built around people who almost keep up. That's where the real money is. Minimum payments, rolling balances, late fees, interest compounding silently in the background like mold behind wallpaper. A family carries $8,000 in credit card debt. Interest rate? Around 24%. If they only make minimum payments, that debt can survive for years, sometimes over a decade, meaning the bank may collect thousands and thousands of dollars on an original purchase that's already forgotten. The TV is broken. The vacation photos are buried somewhere in the cloud. The restaurant meal is literally gone forever, but the debt remains alive, still feeding. Banks used to need deposits to make money. People saved cash. Banks lent it out carefully, but consumer credit changed the equation. Now banks don't just lend money, they manufacture streams of future payments. Entire Wall Street models are built around estimating how likely you are to miss a payment by exactly 12 days. Modern finance became terrifyingly good at understanding human weakness. Your stress, your habits, your salary timing, your shopping behavior at night versus morning. Because friction is the enemy. The less pain you feel while spending, the more profitable you become. A car repair happens. School expenses rise. Rent jumps 18%. Groceries get weirdly expensive. So the card absorbs the shock. That's what it's for. At first, then the balance lingers, then another emergency arrives before the first one disappears, and suddenly the household starts functioning like a small financial institution. Income comes in, debt payments go out, interest accumulates, cash flow becomes survival. The family is now managing leverage, just like a bank. Except actual banks have teams of analysts, government protections, and access to nearly free money from central banks. Middle-class families get cash back points. After the 1980s, wages in many developed economies started slowing down compared to living costs. But consumption couldn't stop. The economy needed people buying houses, cars, electronics, subscriptions, vacations, furniture, phones. Growth depended on spending. So credit quietly filled the gap that wages no longer could. Instead of giving households significantly more income, the system gave them more borrowing power. And for a while, it looked brilliant. People felt richer. Homes got bigger, cars got nicer, everything stayed alive. But debt has a strange personality. It lets you pull tomorrow into today, which means eventually, tomorrow arrives. Credit card debt exploded. In America alone, it crossed $1 trillion. That's not just consumer behavior anymore. That's infrastructure. The economy is now partially dependent on people staying in debt because when consumers stop borrowing, everything slows, retail weakens, growth falls, companies panic, layoffs begin. Debt stopped being a side effect of the economy. It became fuel for the economy. Credit cards changed something deeper than finance. They changed time itself. Previous generations saved first, then bought things later. Modern credit reverses the sequence. Buy first, figure it out later. And when entire populations start living slightly ahead of their income, the financial system gains enormous power because indebted people behave differently. They tolerate jobs longer, delay risks, avoid instability, stay economically predictable. Debt doesn't just shape spending, it shapes behavior, which raises an uncomfortable question. If the modern economy needs households to stay indebted in order to keep functioning, then are credit cards really a financial tool, or are they one of the most sophisticated labor extraction systems ever created? Because every swipe feels small, but at scale, those swipes may be quietly running the world.